Okay, guys, you might find this interesting, but I always talk about price action profile and how price actually accumulates, creates a stop run, and then moves in the direction that it intended to move in the first place. Okay, you look at a daily candle, you've got the opening price, you've got the liquidity run, then you've got the actual move followed by a closure normally underneath the high of the day. Okay, so if you look at it like this, if you reference this to a daily candle, a weekly candle or a monthly candle, normally it's the same on each and every single time frame. Okay, so you've got accumulation, okay, which is, this is Monday, so this is the start of the week, and this is why I don't trade Mondays. It's because I like price to be able to do this accumulation phase before then making its liquidity grab. And generally, most of you who've been in this group a long time will always say that Wednesday, Thursday, sometimes Fridays are normally my better trading days, and it's a lot to do with this. So you've got the accumulation, you've got a liquidity run, you've got the actual move before you get a retracement down, maybe to opening price, which is what I've marked here, before the move continues, right? And then towards the end of the day or the end of the week, whichever candle profile you're looking at, you'll get a high of day, and then the candle close will normally sort of start retracing something like this, and then it will close. All right, so this is a weekly profile on a weekly candle. However, if you to use this on a daily candle, okay, it's virtually the same sort of thing. Now, what I've marked out here at the bottom is, you can see, so from this point here, okay, this is the start of the day. You've got the Asian session. Some people say that midnight New York is the actual official opening. You can see this is accumulation. You've got a stop run, and then you've got the actual move. So what I'm expecting today is for price to come down somewhere around about here, and then continue up before closing around here somewhere. All right, now you'll notice that I've marked this area here, and I'm going to drop down to the 15-minute time frame, because we discussed this in the live room just now, and when you look at it this way, it makes complete sense, right? So what I've marked off here is the 130 open. Okay, so you've got the 130 open here, which is New York. Now, if you wanted to mark off the Chicago open, we're actually looking at this candle here. All right, now if you mark off the New York session open, the Chicago open, and also the Asian low, okay, you'll notice here that what Frankfurt has done is it's come down, it's taken the liquidity from New York session yesterday. It's also taken the liquidity from the Chicago open yesterday, and it's also taken liquidity from the Asian low session also overnight and yesterday. And what's happened, as soon as we've taken that liquidity, the next candle here is bullish. Okay, so the liquidity grab has been made. You've got a full confirmation candle, which in turn you could have entered on the close of the candle, or using my my Garn box method, which a lot of you who've taken the course will understand. You've got the confirming candle has to close in its upper 1/3, right? So you can take the trade anywhere here, as long as you've got, so let's say we wait for a retracement, as long as you've got your stop loss, underneath the lower of the candle. All right, so that would have given you 2R in about half an hour. Now the second entry, okay, is pretty much the same process. Okay, we've got a market structure shift here. Okay, then you've got this fair value gap here, and again you'll see the same principle is being applied. Once we've got our fair value gap, we enter on the 0.3 retracement of that fair value gap in the direction of the trade. Okay, you can also you can enter the top of it if you want. It all depends on your threshold to risk, etc. But if you wait for a confirmation of that, the majority of the time the trade is gone. So you would have entered that with a 12 pip stop loss. I mean, within 15 minutes you would pretty much hit 3R, but your 2R would have been hit within 15 minutes there. So in terms of, you know, saying what is the profile and what is the market actually doing, you know, it's not very often that you see a candle without a wick to the low which closes higher, and the same in the opposite direction. You know, it will accumulate or it will move the opposite direction before it moves in the actual direction. It's just coming for a small amount of liquidity, sometimes on the lower time frames, but on the higher time frames it's the same principle. So this is actually a weekly profile here. So you've got the weekly accumulation before weekly stop run, which is, by the looks of it, was Tuesday moving on into Wednesday. Then you see price start to move in the actual direction. You can almost see, you know, like a head and shoulders pattern here. If you want to trade retail patterns, it's the same principle. It's break a structure and then look for a new higher low, followed by another higher low, etc. But there was a very good example of that this morning on, you know, this sort of an accumulation here, going in maybe even from yesterday's New York session. There's accumulation here before we fake out. People call it fake out. It's a liquidity grab, right? So we're taking money off yesterday's session. So you've got the Asian low, you've got the Chicago low, and you've got the New York low. All of them been taken out before price moves in the actual direction. And if you wanted to add another confluence to this setup, you've got another retail pattern just here. So you can just use a parallel channel. Okay, mark out your retracement zone. You've got your early entry here, which is after the liquidity grab. You've actually got a nice clean break of the flag, so it's a bull flag pattern, followed by a retest, and then boom, price has moved in that direction again. This retail method would probably give you a lower risk to reward in terms of, you know, this would be the optimal entry, obviously. Probably more of an aggressive entry as well. Once you've waited for the structure to break and then you've got that fair value gap, the power of these 15 million fair value gaps in accordance with the Garn box and the 0.3 retracement of it. You see yesterday I posted one trade which unfortunately didn't pan out right, but we got in the second trade and we made our money back anyway. So this is my optimal entry here. This is more of an aggressive entry, so if you were going to enter here, I'd go with a lower lot size. But for sure, this would have been a beautiful trade. If I wasn't taking the kids to school this morning because the little buggers missed the bus, I would have been in and out of this trade in probably 15 minutes. Maybe I would have held it because the momentum coming off this candle was ferocious. So you think that it's going to have at least some follow through, and maybe I would have TP'd about 0.3. So 3R maybe. It's only 38 pips. All in all, would have been a good trade. So anyway, I hope this makes sense. Just we were talking about it in the live room just now, and I thought I'd try and give you guys a little bit of information, because I know not all of you can come to the live sessions, but if you can, I'd be sure to make the next one. All right, see you guys in the room.